So we're delighted to welcome Luc Van Hof talking on his system. He's a fund manager, and he also has an alert service on Enigma, and he's on about a bunch of other services as well, interactive brokers and others, with his trend following system. But it's a lot more than a trend following system. It has very attractive returns and drawdowns. So it has the balance of the two, and it includes non-trend following or counter trend following elements as well. So that's just my interpretation of it. So I'll hand it over to Luc.
Hi, thank you, Don. Thank you, Don. So welcome, everyone. So what I would like to do today is actually give a brief overview of how I trade the S&P market, the S&P futures market. Now, my first love, so to speak, is trading options on the S&P, but that's a more complex story. So I will stick to the futures trading, the Enigma program, as I've called it, that I've been using for many, many years. So today I would like to give a brief overview of how I look at the market, what is basically the investment philosophy and the trading strategy that I developed based on that trading or investment philosophy. So as you will notice, we'll focus a lot on the risk management. Contrary to what most people do, I'm more concerned with managing the risk than trying to manage the return. Of course, both elements are important, but my focus is really on trying to control the risk in trades. And because it is a pretty wide and large subject, I will give a brief overview first, but please at any time, don't hesitate to ask questions, interrupt me. It's not a problem because I can talk for hours, which is not the purpose, but I'll give a brief overview, as I said, of the trading strategy. And then we can spend a lot of time trying to answer different other questions that you may have once you heard how I basically try to build and how I trade this approach in the S&P market. So as you can see on the first slide, it basically summarizes it, what I do. It's a truly complete trading strategy because it will use different types of trading styles. It is fully systematic, so really 100% systematic. It's totally independent of the person executing it because the computer is generating the signals. It is also what I call market agnostic, so it has no bias to the upside or to the downside. It works as well in down markets as in up markets, actually slightly better in down markets, I must admit, for reasons that I will try to explain later. And it's fully transparent to that extent that there are no hidden things behind it, like little tweaks that you need to apply to really achieve a decent return. It's pretty plain vanilla, as I hope you will see through the presentation. So in terms of content, as I mentioned, I'll talk, of course, about what is the underlying investment philosophy, then what kind of trading engines have I built over the years, what kind of time frames we look at, how we trade, in what direction, and then, of course, a lot of time will be spent on risk management and trying to structure the risk. Now, as a result of that, we will see that you can build different types of Enigma, in other words, different variants, and we'll have a quick look at the key metrics of these different, or of the main variants, I should call it. We'll have to talk, of course, about trade size and leverage, because it's really a very important feature of the whole program. And then we'll make a quick comparison to the S&P 500 market, which is, in a way, our benchmark, because a lot of people who invest in Enigma, they are either invested in the S&P or use Enigma as a substitute to invest in the S&P. And then I'll just conclude with a couple of reasons why it could be interesting for someone to look at this program. So without further ado, the philosophy behind it is actually quite simple. I am a big believer in simple things. And I say, well, basically, I don't know what's going to happen. So that's why I try to be aware of how much I actually don't know when I'm trading. So what I'm trading is basically using methods that have been tested, that are, in other words, research-based. So I'm not using gut feel. I'm actually very bad in terms of intuition or trying to find or guess market direction. So I gave up on that a very long time ago. And so that's why I try to say, well, I'm not going to try and predict the market because it's really too difficult. I'll just try to go with the flow and try to find some patterns that are recurring on a regular basis. So why is that? Well, because I think that markets are pretty efficient. It's pretty difficult to beat the market on a regular basis. And the reason is quite simple. Over the longer term, the market is really quite efficient. It's very hard to come up with some serious research that demonstrates that the market is inefficient most of the time. Actually, it's efficient most of the time. However, on the shorter time frame, and with shorter time frame, that's of course a very subjective definition. For me, it's something under 1 week, I should say, under a holding period below 1 week. Then we could say that the market on a regular basis offers some, call it, imperfections. And these imperfections can take the form of two things, either in the shape of what I call inefficiencies, which is something which is caused by the market, and it hasn't been noticed by all market participants, or it could take the form of a risk premium. And that's, in a way, a different word to say, well, you can get compensated for taking a certain risk, but that risk sometimes is actually mispriced. And so we end up with some, call it, anomalies that can be used as a foundation to create a trading system. And by trading system, I simply use this term a bit broadly, but I mean a set of rules that define in very clear terms how and when you get into a trade, and what kind of protection you use for that trade, and also how you're going to exit or abandon that position. So the whole system is built around our belief that markets are really what I call efficiently inefficient. And what does that mean? Well, the market is not perfectly efficient, nor is it completely inefficient, but it's really quite inefficient, and in such a way that traders and money managers can get compensated for their efforts, for their costs, through the profits of their strategies. But on the other hand, it's also efficient enough so that it's not too easy for other parties to join the party. In other words, you can't really get encouraged to do active investing and trade without a very well-researched system to try to extract some profits from this market. So it's like in between, but mostly efficient over the long term and occasionally inefficient in the short term. So that sounds very theoretical, maybe. So that's why I would like to highlight the key aspects of the trading strategy. So what are we going to do? We're going to trade the most liquid index on the planet, which is the S&P 500 futures contract. And we will be using different types of strategies. In other words, they have been quantified, they have been tested, they have been researched very well and at length and tested over time. So we know that they have some additional value and some added value to most traders. However, not a single one of these three algos, or families of algos, I should call them, because you will see there are three different types, and depending on leverage and other things, we can use small variants of these algos. But it boils down to using three different types of trading strategies to come up with a certain trade direction, but more importantly, trading size. So it's not so much that we try to pick the right direction, it's also a question of how much are we going to trade in a certain trade direction. So these are three different, of course, very different, but compatible trading styles. And what makes them rather unique is we have not used any type of parameter optimizations. In other words, we don't really want to fall into the trap of curve fitting, data mining, trying to build something based on historical data, which looks great in a backtest, but doesn't work if you extrapolate it or if you trade it forward in time. So that's why it's a pretty simple system, believe it or not. It's not rocket science. If I would show you the code, you would see that there are many lines of code, maybe something like 4,000 lines, but it has more to do with the trading size determination, with the risk management, rather than trying to come up with a very complex and complicated trade entry system. The trade entry system is quite easy, but the trade management system is quite sophisticated. Now, another important aspect is that we use different time frames. And so we'll look at the market using very, very short time frames like tick-by-tick data, minute data, daily data, weekly data, so multiple time frames. But all the trading, all the implementation, the execution is only and exclusively done during the day session. So we are not using stops overnight. We are not using entries overnight or in early morning or after the market closes the regular trading hours. No, it's only during this relatively short time frame of about 6.5 hours that we execute our trading program. Now, we have many different inputs in the system, but we end up with actually relatively low frequency trading, about 7 trades a day. To give you an idea, this year to date, I've sent out, and I can just give you the exact number. Let's see. So today I sent out number 78 in terms of trade alert, and I've done 36 trades so far this year. So it's about 1 trade per calendar day on average. So we have about 7 trades per week. So about 1, sometimes 2 trades in a day. We have very busy days where we have like 10 trades in a day, and then we have sometimes a week with only 1 trade. So it's fluctuating quite a bit depending on the market activity. But so that's for what concerns the general trading aspects. So now, how do we build such a program? That's of course the key question. Well, it's actually quite logical, I think. So we start from these so-called market anomalies that we try and pick up by having watched the market for many, many years. I've been doing this for many years, many decades, I should say. And if I think that something is a bit weird and out of whack, so then I try to build like some statistical empirical evidence and try to find a good reason why it's there, why it's existing. And if I can try to explain it, that's one thing. But then, of course, I need to find some kind of statistical proof that it's going to be reoccurring and recurring on a regular basis. If it's only there this year for 3 weeks or for 3 months, and it hasn't happened in the past, and it's probably not going to happen again in the future, then why bother? So it has to be there on a regular basis. So in other words, the trading algo, the trading strategy, has to be active on a regular basis. We can't really deal with a system that trades 3 times a year and has 3 fantastic trades, because statistically speaking, it doesn't mean anything. So it's really important that we find enough trades to basically build an algo around it, and also try to find some way to what I call monetize the edge that we have, that we think we have discovered. So provided these first 3 steps go as expected, in other words, they turn out rather well, then step number 4 is actually the most difficult one and the trickiest. Because over the years, I've seen that it's not extremely difficult to find a way to trade this market if you trade it very, very small. However, once you start to build positions of a certain size, then it becomes much, much harder, because then you'll have to be able to take liquidity from the market or generate liquidity to the market. So in other words, it must become scalable. If it's not scalable, it's actually not worth the effort. So that's the toughest portion of the puzzle, I should call it. But with these 4 building blocks, you can build what I try to describe as structural alpha. In other words, some alpha that is there on a regular basis. Now, what are these 3 trading engines or trading algos? Well, we have one which is a very simple one, which is usually described as some kind of short-term trend following. It's a momentum based algo that tries to find some bullish or bearish directional movement. And it tries to detect that across different time frames, from these very, very tiny moves using tick-by-tick data up to daily data and even sometimes weekly data. So once we have this kind of momentum built and confirmed across different time frames, this first algo could generate a bullish or a bearish trade signal. Then the second one, the so-called bias, is what is called a 2-layer decision model. What does that mean? Well, it's simply going to try and solve a so-called classification problem. And by classification problem, it is understood that you try to put it into a certain bucket. Is the market going to go up or is the market going to go down? Something very, very basic, so a binary problem. And once that classification has been done, it has to pass a certain threshold. In other words, it's not enough to say, well, the market is clearly going up. It has to go up beyond a certain threshold. If we say, well, the market has some directional movement to the downside, it has to be significant. In other words, it has again it has to show that it can go beyond a certain minimum distance. And once all that is done, it passes the first layer of the decision model. The second layer then actually is simply a confirmation test, where we actually use all these buckets that contain certain data and try to find some confirmation. So this is maybe a pretty weird or vague description, but it boils down to trying to see if the market is going up or if the market is going to go down. It has to be showing some, call it directional strength, some trending power. And once that's done, even then we require an additional confirmation that it goes beyond certain other thresholds. So it's not very easy for this market or for this algo to generate trading signals. But when it's there and when it's active, it can be pretty powerful. Now, the third one is the toughest one to execute. And why am I saying that? Because it's going against your natural tendency of trying to go with the flow. So it's usually going against what is happening in the market. In other words, the market is falling out of bed. It may end up generating a buy signal. The market is showing a very strong rally. Well, it may end up showing a sell signal. So it looks very weird. And on top of that, it uses, again, this binary classification. It says, well, the market is either going to go up strongly or going to go down strongly. But on top of that, as I said, it uses a reversal approach. So it's never going to be, apart from one special situation, which has to do with time. But in most cases, I should say 95% of the time, it's going to go from either net long to net short, and from net short back to net long. So it's not simply going to exit the position, but actually going to reverse the trade. So these are 3 different families. So the trend following or momentum type trading approach, then this pattern recognition 2-layer bias decision model, and then this contrarian or hedging algo. So the hedging algo is actually the most interesting one because it's the one which is the most difficult to implement. And when people when I would give the code away for that hedging algo, I can basically guarantee that very few people would be able to follow it because it's psychologically extremely tough. Now, why am I including it? Because it's going to deliver a very good diversification with respect to the 2 others. So on a standalone basis, it could be extremely interesting, but it's even better when it's integrated with the two other elements. So the power of the Enigma trading engines is not so much that I have developed or designed or come up with some extremely smart, intelligent, unbelievable trading algos. No, it's more in the power of building call it a foundation, which uses these three different approaches that combine very well. And so as a function of how they can be combined, you can achieve some pretty remarkable things. And of course, this has to do with the fact that they don't correlate. In other words, they do something very different, each of them. So it's very exceptional that all three would go in the same direction. It's very exceptional that all three would be flat. So we will be in the market a lot of the time, but sometimes we would end up with a net position of actually zero. How can that be? Well, for example, today is a good example. We went short pretty early in the day. So we entered with a short trade. We had a second short trade. Then the market unfortunately went up. We exited the trade and then we're ready to go short again. Then at the end of the day, we actually covered the short position. So we were short with the momentum and actually went long with the hedge. So net position is flat. So how can we make money? Because we traded in and out of these positions at different points in time and at different prices during the day. But the overnight position is usually relatively small. And that's a good thing because you don't use stops overnight, which can be tricky for some people. So what can be done, of course, is using some options overnight to protect these positions. Now, as I said, we use different time frames and different trade directions. We could end up with really quite a bunch of different variants within Enigma, because we could say, well, I'm only going to trade at the end of the day. Well, I'm going to trade only for scalping purposes. I'm going to combine the two. So finally, the most interesting combination I found is to use two different types of trading styles. One is what I call intraday, which basically means you generate trading signals during the day, i.e. between 9:30 New York time and 4 o'clock. And at the same time, at the very end of the day, the end of day features, they also can generate some signals. That's like the most complete set, which is what I call intra. Now, the end of day, of course, is only using end of day signals. So that's very simple to implement. It only has one trade at the end of the day at most. So sometimes for a week, it doesn't trade at all. And then it maybe goes into a trade and stays with the trade for several days, if not weeks. But the average trade length, the trade horizon, so to speak, is about 5 trading days. So it's not holding positions very long on average. And of course, we could say, well, I'm interested only in the long trade. So I'm interested only in the short trades, or maybe I'm interested in both. So as a summary, we could, and I'll show you that in a second. I'll show you actually right away. So here we have the 3 variants that I consider the most attractive ones. One is the intraday long and short in yellow. One is the intraday, but only using long trades. So it's never going to go short. And then there is the end of day going long and short. But we'll come back to that in a moment. So risk management. Risk management for me is really the key. Why? You can take whatever strategy. If risk management is not really quite well developed, it's going to end up in tears. With bad risk management, even a very good and potentially profitable trade idea could end up in a losing proposition. So you really need some very strong risk management to basically defend what is coming at you and actually trying to protect your position to the extent possible. But the more important reason for me to attach so much importance to risk management is the simple fact that you really can't do anything with regards to return. I mean by that, you can't really predict return. I could not predict if the market is going to go up or down, let alone how much and what is going to happen in the trading day that's ahead of us. However, in terms of the risk management, I can do a lot. I can say, well, I'm going to trade small size or bigger size, I'm going to use a wide stop or a very tight stop. I'm going to use a trailing stop. I'm going to add to my position once it's going in the right direction. I'm going to scale it down. So there are different possibilities there. And that's why that's really the key of the system, because it's what I call the choice and the only choice of the trader, while return is really the choice of the market. So it boils down to trying to find a good way, an effective and efficient way to build what I call convexity into a trading strategy. And of course, this needs to be done at reasonable cost. What do I mean by that? So simply said, the more my trade is going into the right direction, the more I will add to the position. When it's going against me, I'm going to scale it down. In other words, to try and avoid huge drawdowns. Because for me, drawdowns is really the key metric. In all the systems that I've developed over the years, it's always focusing on maximum drawdown. Why? Because it's really the most pain that you need to avoid. If you can avoid a drawdown of, say, 20%, well, then you know that you will never have to make a 25% return to get back to break even. If you let it go down 50%, of course, you realize you now need to make a 100% to get back to break even. So these kind of things are extremely important. And this volatility drag, as it is usually described, is really one of the main features of the program. So we try to avoid volatility drag. In other words, we try to avoid big drawdowns, because we can't really know and hope that we can make a lot of return in the next couple of months, let alone weeks. So what do we use for risk management? As I already mentioned, it's really position sizing. So the size of the trade is really key. So we'll start usually with a small one lot, or sometimes a two lot, but never more than that, and then scale up and build this position into a bigger one. Then, of course, there is this tail risk hedging, so the contrarian approach from the third algo, which is going to help a lot in reducing the size, and which also explains why even when the market has a very strong rally, we will be intraday buying some contracts during the day, but then usually at the end of the day, the tail risk hedging is going to kick in and actually start shorting, which basically boils down to the net position being smaller and ending up with maybe a flat position or a very tiny net long position. So the key metric that I've selected to build the program is this peak to valley or maximum drawdown measured on a daily basis over the whole period. So I'm not using close trade basis, which basically means that, imagine I go long on a Monday today and I pay, say, 4,120 to go long in the S&P, and I stay with the trade till, say, Thursday, and then I'm exiting at 4,100, so obviously I lost 20 points. However, I could then say, well, 20 points, 20 divided by 4,120 is so much in percentage terms, that's my drawdown. Well, that's not good enough, because what may happen on Tuesday and Wednesday, so before I'm closing out the trade, is quite essential and quite critical in the effect it may have on the total portfolio. Because one trade could last for like 4 days, the Monday to Thursday example, but maybe in the meantime, we have other trades which already were built last week, or which we will build tomorrow or the day after, and they all have to be taken into account. So we calculate this drawdown on a daily basis, even for the open positions. And then we use, of course, volatility, because it's all centered around market volatility and trying to describe the probability distribution of the underlying index, which, of course, as you all know, because you trade options, I understand, is fat-tailed and skewed. So we use that as a central building block for the program. Now, in terms of risk management, of course, we have to ask the question, how are we going to structure this risk? Well, three and only three things, in my opinion, should be addressed. It's about preventing these huge losses. In other words, try to avoid these black swan adventures, which are very tough to recuperate from. Secondly, portfolio construction, where we don't really try to find things that are lowly correlated. Why? Because correlation is non-stationary. In other words, it's changing over time. Something which is not correlated with a second thing today may be highly correlated when the market is taking off dramatically to the upside or falling out of bed dramatically. Correlation will probably go to 1 between these two elements or two instruments. So we need something which is really effectively diversifying. And how can we achieve that? Well, simple, by using different instruments or by using different approaches, trading systems, trading methods, but very easily using different time frames. If you have a system which works well, say on the daily time frame, and it works well, say on the hourly time frame, combining these two already will provide you with very nice diversification, because they will generate trading signals at different points in time, obviously. And then the third factor, which needs to be used for structuring the risk, is of course the size of the position. And that's of course where we try to control this famous maximum drawdown. So there again, we don't focus on covariance, because for the same reason, it's an input that we have to estimate and that is not stable over time. While drawdown is something, if we say, well, I will never want to see a drawdown bigger than X percent, and X could be, say, 20% or 15%, well, we can build the size of the trade in such a way that it will be very hard to exceed that number. So we need to trade in a smart way and manage the allocation, in other words, manage the exposure on a continuous basis. Now, as I said earlier, showing these three variants and their key metrics. So what's so interesting or important about it? Well, first of all, what I show there in red is the fact that they all have the exact same maximum drawdown. Of course, that is a function of one's risk profile. If someone says, well, 15%, that's really not enough for me, I can stomach a drawdown of 25% without any problem, you can simply scale it up. If you say, well, 15% is way too big, I can only stomach a 5% maximum drawdown, of course, we can decrease the exposure. Simple. And the fact that we now have this additional granularity with the micro EMini S&P, while before we only had the EMini S&P, and before that, of course, the big contract, which I traded a couple of decades ago. So now we can really fine-tune the exact exposure that we want. So what am I looking at or showing here? Well, first of all, the net CAGR, so the compound annualized geometric return. Then what I call the 3R, which is simply the return, the net CAGR divided by this maximum drawdown. And in this slide, on this slide, the maximum drawdown, of course, is always used as 15%, selected 15% as principal risk determinant. So in other words, everything is compared to a maximum drawdown that is to be expected. It's not necessarily guaranteed to be hit, but it is built in such a way that we assume that at one point in time, sooner or later, we will have a 15% drawdown. So this 3R, or reward to risk ratio, as it's usually called, is simply the net CAGR divided by the maximum drawdown. Then, of course, we have the standard deviation of return annualized. We have the Sharpe ratio, which is around 1, slightly above 1, and the Sortino ratio, which is, of course, looking only at the so-called downside deviation. So only taking the losing trades into account. And we try to be there at around 1.5 or higher. Now, in terms of trade frequency, you'll see that, of course, if you trade and take every single signal, you have about 218 trades per year. Sometimes it's, of course, only 150, sometimes it may be 300, but around 200 trades per year. So about 4 per week. And by trades there, I mean in and out considered as one trade. So in terms of transactions, you should double the number, of course. Then the terminal wealth value, in other words, you start with $1. What can you expect after fees? These are numbers after fees. After 10 years, well, about $12. What's your minimum exposure and your maximum exposure? it's about -2 or +3. What do I mean by that? So 300 deltas to the upside or -200 deltas to the downside. In other words, you have an account of, say, 10,000 or 100,000, let's use 10,000, well, you could get a position which is as big in notional size as -20,000 at one point in time. Is it going to happen frequently? Not at all. To the upside, if I trade a $10,000 account, how big can my notional exposure grow? Up to 30,000, so 3 times that starting account value. So you'll see, of course, that the fewer trades we take, if we abandon all the short trades, we end up with only 12.9%, so about half of that. And if we trade only end of day, which is for me a very interesting proposition and a very easy one to implement, because you only have one time segment or one observation per day, which is actually at the close of every trading day, you only have about 100 trades per year or 200 transactions per year. And you still end up with about 13% for a drawdown of 15%. Now, this trade size, I mentioned it, and the leverage, well, I'm giving here the example of someone who's using a $40,000 account size. So if we use this, what I call the dynamic investor with an acceptable drawdown of 15%, using close trades and daily returns, well, you could end up at a certain point in time with an exposure as big as 3 times that 40,000. When is that going to happen? When you would be long 6 contracts. 6 contracts with $50 per point, with the S&P assuming at 4,000, then you could end up with, of course, 3 times the 40,000, 120,000. How often is it going to happen? Well, not very often. You see that here in the table, about 2% of the time, you would be showing a net position delta of plus 300 deltas. You would end up with a minus 200 delta position about 5% of the time. But say the majority of the time, you will have a flat position, actually 28% of the time. And in most cases, you will be between, say, minus 100 and plus 200 deltas exposure. So it's very simple. You buy one EMini S&P or one micro EMini S&P per signal. If you say, well, I want to have more exposure, you simply trade in slightly bigger size. So this is what I consider the most important slide of the presentation. And it's maybe a more tricky one to understand. So what am I showing here? It's on the x-axis here below. You see the 0.5 is buying, say, is 50 deltas. So in other words, we are buying one S&P future. So we get 50 deltas compared to the SPX. And if we buy 2, of course, we end up with 100 deltas. And anything in between is gradually adding one micro EMini S&P. So we build from 50 deltas to 55 to 60 up to 100 deltas. Now, what does that show? In blue, on the left scale, we see the return per year, which is about 10%, slightly more. Next to it, the maximum drawdown, and next to that one, the standard deviation. So what is pretty remarkable is that even though that the standard deviation is in gray slightly higher, it's always smaller than the return per year. And at the same time, it's bigger than the maximum drawdown. So what does that mean? It basically means that although the return is going to change quite a bit, the big surprises or the big shocks are coming from the upside. So your drawdown is going to be smaller than your standard deviation. In other words, you could end up with maybe a 10% volatility in return, but maybe only 7 or 8% maximum drawdown. Or if you trade it more aggressively, as I do, like take this 75, where you trade one S&P future and 5 micros, you would end up with 75 deltas. Your return would be around 30%, 31.5 apparently. And actually you see the maximum drawdown is 16.4, but the volatility is 21%. So over time and by scaling up your exposure, you actually not only increase the return, of course, you increase the risk as well, but you get more and more return for the additional risk that you take on board. So the ratio between the return you gain by trading it slightly more aggressively is higher, or is bigger than 1, I should say, because it's generating more return that you receive for every additional unit of risk that you add. In other words, the Sharpe ratio, the green line, is sloping up, not dramatically, but it's not a descending curve, which is, I think, a good thing. So it's very scalable. So if you start here and you're aiming for like 12% return or something, let's see what the number is. It's 13.0, okay? And you move up the ladder because you think, well, I have confidence in the program, and you add one micro EMini, you go from 13.0 to 16.2 by simply adding one tiny micro EMini S&P future with every single trade signal. And that's the way you can basically build it up to maybe 75, as I'm usually trading it, or even higher to 100 deltas per trading signal. Now, this is an example of real-time trading since January 2015. And what is remarkable is that, you know, the S&P or SPX, I should say, returns for the different years from these years 2015 to 2022. And you see that, especially during the bad years or the difficult years, the program is doing quite well. Take, for example, 2018, the market is losing 6%, it makes 15. Take 2020, the market had a very bad start of the year, of course, in 2020, February, March, but the program really has an outstanding year with 96%, which was truly exceptional because of this huge profit in February, March. And then last year was also quite good, with the market down about 19.44 on the SPX and the program making 33. So you see that in the down markets, it's usually better. Take a very easy year, and I think of easy years like 2017, the program is really not performing very well. And why is that? Same happens in 2019. Market is making 29%, I'm only making 7.5. Take 2021, market makes 27, I'm only making half of that. So usually in the up moves, it's lagging because, as I explained earlier, it's trying to capture a portion of the move. It's waiting for confirmation. It's hesitant. It's filtering out a lot of what I call noise. So it basically results in always buying after the bottom, always selling after the top. So it's not predicting, it's in a way trend following because it's using momentum, it's using some pattern recognition, and it's using some extreme trends in the tail hedging. So it's always going to lag strongly in an up move, while in the down move, it's actually quite good. And I think I have one slide. I'll go to that slide straight away. This one, which is actually, I think, quite interesting. It shows over that period, 2015 to 2022, the best 10 months for the S&P, which are listed here. So we had April 2020, the market went up nearly 13%. November 2020, the market went up nearly 11%, and so on. Now, what did we do? Well, only a fraction of that. So you see the 84% that was gained by the S&P 500 index during these 10 months. Actually, we could only achieve about 30%, say 35 to 40% of that number. So sometimes we even have a negative return when the market is really doing very well, like in October 21. Like in July 22, the market went up dramatically. We only made 0.5%. So it's not really good, as you can see in the chart, in capturing very strong, significant swift up moves in the market. The other side of the coin is, of course, let's look at the 10 worst markets, or worst months for the S&P. And then we see that in March 2020, which is actually preceding the best month ever, we had the worst month ever, minus 12.5, plus 12.68. Well, we really made a staggering 43%. In the other down months, which are really significant, minus 9 to minus 6, I should say, we usually make money, and sometimes 3, 4, 5%. So, and that's really the power of the program, I think. It's that during the big negative months, it's usually making a profit, or definitely only losing a tiny portion. So it's really exceptional that the market is losing 5%, and we would be losing 5% as well. So it can happen that we lose 1 or 2%, as we show here. We lose 1% when the market is down 9, but in most cases we end up with break even or a positive return, and sometimes a very nice positive return. Like in June 2022, the market was down 8, we make nearly 5%. Or the market in April 22 was down 8.8, we make 4%. And the same happened in September 22, market down 9, we're up nearly 4. So combine these two things, and of course you end up with a nice graph like this one. So what is obvious? Well, during the easy years for the market, we underperform, and sometimes significantly, but we still end up with some positive return, but nothing to speak of, and definitely not comparable to the S&P index. But when the market is really hitting a tough portion, or it's having a tough ride, you see that we actually are starting to diverge, like in 2020, like in 2022. And you see these opposing directions, it's diverging most of the time. So that these are the numbers, risk return statistics that I look at quite a bit. So here is, for this same account, you see that the return was about 19% net after fees, with a 1% management, 20% performance, but with a drawdown of only 9%, or 8.7 to be precise. So it's about half the drawdown that we make. So the drawdown is about half of the average annualized return. And standard deviation is a bit bigger. So the drawdown is again smaller than the standard deviation. And the Sharpe ratio is above 1, actually here 1.5. So this program, of course, is using slightly less exposure. The drawdown is not 15%, it's going for smaller profits, but still decent, nearly 20%. So high double digits, so but between 10 and 20, I should say. The purpose is to try and come up with a Sharpe ratio which is exceeding 1, and with a Sortino ratio which is exceeding 1.5. So that's the purpose. Now, the other important statistics that I look at is the so-called underwater after 12 months. What does that mean? It basically means that whatever the point in time that you start, how likely is it that 1 year later you're underwater? In other words, you haven't made a profit in a year. So how often does it happen? If you're really truly unlucky, well, it will happen less than 10% of the time. So in 90+% of cases, 1 year after you started, you will be up money. So, which is of course a comforting thing to know. And the drawdown, is it heavy? No, it's not, but it could be very lengthy. So it's also important that we really don't have a drawdown which is lasting for, say, 2 years, 3 years, because very few people will continue to trade a program which has a very lengthy drawdown. So I focus a lot on minimizing the length of the drawdown, and at the same time, of course, minimizing the depth of the drawdown. So what else can I tell you? Correlation, of course, it's all over the place, because there is really no stationary, as it's called, correlation between S&P and Enigma. You see, it can be on average around 30.31, sometimes as high as 0.75, and at other points in time as low as minus 0.65. So it can be all over the place. If you look at it on a slightly longer term window, say a 3-year look back, you see it's about the same thing. Correlation is about minus 0.30. So it's still around zero. So it's not that it's usually negative or usually positive when compared to the S&P, it fluctuates. In other words, most of the time it's between minus 0.23 and plus 0.55. It's exceptional that it's outside of this interval. So why would people invest in Enigma? Well, I think the easy answer is it's doing something very different. So it's a very nice, I think, diversifier to a traditional long equity portfolio. And that long equity portfolio can be built with options, of course, as you all know. But at the same time, it could also bring diversification to a portfolio of options or other alternative asset classes, because it's doing, again, something different. Why is it doing something different? Because it's using mainly a different time frame. It's looking at the market from a different angle. And that's how it basically ends up with providing this diversification element, which is really important in portfolio management, of course. And then obviously I'm doing this with my own money. For many years I've been doing this, or skin in the game, as it's called, which I think is really very important. And then lastly, it can provide some nice, call it hockey sticks. In other words, effective downside protection and an asymmetric return profile, very similar to the expiration graphs of simple options. So you have limited risk. In other words, the drawdown is controlled, it's limited, and you have a pretty decent upside potential. So that's basically where I could end my presentation, and I would like to open it up for questions if there are any. Thank you.
Okay, thank you very much, Luc. Let me start out, if I may. And anybody else, please feel free to join in. Otherwise, I may keep going at risk of keep going here. If I understand correctly, you're effectively using diversification across time frame and sizing as a substitute or a replacement for conventional hedging, which might be, say, buying puts. Is that right?
Well, that is partially right, because the power of using puts as protection is much bigger. Let me try to explain that. If I have a position built to the long side today, so gradually I started scaling into the trade, and at the end of the day, instead of having a long position of +4 contracts, I end up with +2, and I go home with a net long position of +2, and overnight something weird happens and the market is down 150 points, I'm sitting on a pretty serious loss, because there is no protection between the close of today and the opening of tomorrow. While if I would have simply bought a put option, of course, the market is allowed to crash, so to speak, and my put option is probably going to pick up some nice value. So it is not as safe as buying put options for protection of a portfolio. What it does do, it's going to try and capture some return from the market moving. And of course, if I would end the day with a net long position and the market is going up overnight, of course, at the open, I will show a profit. Another big difference between comparing this to an option position and this net futures position is, of course, the time erosion and the volatility. So if the market is not moving, I cannot make money. So I need some movement. If I'm net long, I need the market to go up. If I'm net short, I need the market to go down. If the market is standing still, I could still end up making money with an options portfolio, but I can't with this. So it is different, but it's of course also diversifying, because I'm using different time frames. But all in all, I admit, and that's why I like options better than futures in general, for longer term trading and for core positions like this. I would not use this for like 75% of my portfolio. I would use it for like an add-on to a diversified, say, multi-asset portfolio, and including options, and then build maybe 20-25% of it in Enigma, because it's adding some convexity, actually, as it is, because it's trading in and out of the market pretty quickly using different underlying elements.
And is that some of that because you do not do stops overnight?
That is one of the main reasons. That is correct. That is correct. So stops are not held overnight. So a couple of the subscribers that I know personally, these people, they buy very short-term options, and these could be weekly options if the position goes beyond a certain level. But I think I shown this slide with, yeah, here it is. So you see, it's quite exceptional that the delta is exceeding 200. To the downside, it's impossible. It can only go up to minus 200 deltas. To the upside, it can exceed 200 deltas, but only in 7% of cases on average. So most of the time, our net position, our net delta is, say, between minus 100 and plus 100. So if you add all this up, you end up with something like, oh, what shall I say, 40, something like 60%. So 60% of the time, your delta is between minus 1 and plus 1. So it's not huge. And of course, you can scale that up or down.
Why do you not use stop entry overnight?
That's a very good question. Well, for the simple reason that we would get kicked out of trades too often. So we tested that, of course, to see that, is it worth the trouble, or is it providing any added value to have a stop linked to that position? Imagine I end the day with net long one contract, and assume I went long at 4,110 today, virtually at the low of the day. Well, that would be nice. The market is now 4,123, I see. Well, okay, I'm in the money, and I could use a stop maybe 10 points away, 20 points away, maybe 50 points away. But what's the big advantage? If I have my stop relatively close or nearby, let's assume at 3,997, so about 30 points away, even less, but the market falls 20, 30, 40 points, and then basically recovers, I'm out of the trade. And I took this loss, and it basically shows in all the tests that we've done, that it doesn't really pay to have these stops linked to a position, to a trade, because overnight, if you get out of the trade, it's usually not determining the new trend. In other words, the real underlying strength of the trend following aspect of the program is determined intraday. And by intraday, I mean during the regular trading hours. What is happening outside occasionally can change the trend from up to down, like we saw, for example, last week. I think it was on Thursday, the market started to come down. We had a very strong rally, but then Friday, the market already came back down. Wednesday, of course, was also quite wild with the number that came out. But these kind of changes that take place overnight usually don't really are that important in terms of changing the true trend, the underlying trend. So that's why it wouldn't really provide additional value by using a stop loss, attaching it to a current position. Of course, if someone sleeps better with a stop loss, he or she can do it. But then I would actually prefer to buy some short-term options.
Is there any case for using options for trend following, or would you say that you're pretty well always better to design a system using the underlying for trend following?
Definitely, you can use options, sure. And a very easy implementation would be using it for the end of day variant. So actually, I'm doing that a lot. For the intraday, it's much tougher. Why? Because the spread on the options market, and I'm trading SPX mainly, well, the spread even for the at-the-monies is not extremely tight. And of course, you're going to pay away quite a bit of time value because the spread is maybe 0.3, 0.5, depending on the strike and depending on the expiration. but it's nothing. I mean, it's huge compared to the bid-ask spread of the S&P futures, which is like a quarter of a point most of the time. So it would be extremely costly to say, well, I'm going to replace and use as a substitute for every trade signal an equivalent position in the options. For example, you could say, well, if I have a long signal, instead of buying the S&P and getting 50 deltas on board, I'm simply buying an at-the-money call, and I have 50 deltas as well, or approximately. Well, that would be correct, but when you enter and exit, and I exit with, say, a 10-point profit sometimes, or a 5-point profit, or a 7-point loss, well, these kind of things are relatively modest, but if you translate it to options, after taking into account the bid-ask spread, it really could kill the performance. While if you say, well, I'm not going to use it then for the intraday signals, but only and exclusively for the end of day, it's a different story. First of all, you'll have much less trading, about half of that, even slightly less. You see the 103 compared to the 218, but the average length of the position, the holding period, I should say, of each trade is also longer. And because you don't have the offsetting element when you're using the intraday in combination with end of day, you have going long or going short intraday and doing the opposite end of day, while here you will basically be using positions which are going against the trend most of the time. So it's probably worthwhile using options for the end of day version, but not very interesting to use it for the intraday version.
Is SPX, would SPX be better, XPX options be better than futures options for efficiency?
Yeah, definitely. Yeah, definitely.
Okay. Looking at your chart of returns, it looks like they got better as time goes more recently, or at least the earlier ones didn't show the so much gain, or am I misreading it?
Are you referring to this one?
Well, there was another one that had a curve, that had curves on it over time.
The chart, this
that one, yeah. It looks like a recent.
Well, I think that's optically misleading.
Okay.
If I use a logarithmic chart, the picture is going to change a bit. Now, of course, if you look at it at 2022, 2020, 2018, so these years, we had some serious corrections. And of course, in that period, you see the returns can be quite nice. So the difference between the -6 and the +15, the difference between the +16 and the +96, and the difference between the -19 and the +33 is really huge. While when I'm lagging or trailing the market, like in 16, 17, 19, 21, it's a significant lag, but not as big as the gain we made in the other years. So if you have many negative years, or in other words, not negative, maybe not the correct term, but a lot of volatility in the market, it's usually better.
Oh,
so 2017, low vol, not good for the program. 2016, low vol, not super. 2015, we had, of course, August, September, but that actually was a bad period for the program. And then we have 2019, also relatively low volatility. You see, it's not so good for the program. If you have high vol, like in 2020, 2022, it's much better. So the volatility is really the driving force. So we need to, the worst environment, if you would ask me what is the worst environment for the program, it's usually when we change direction too often. Like the momentum algo, the first one, which is doing some trend following short term, is going to put on the wrong foot on a very regular basis. If we have a buy signal today and the market goes up, fine. The stop is relatively far away. If the next day the market continues, good, the stop is going to be tighter than before. Stop is always going to get closer, of course, not wider or further away. But if the third day, the market already changes trend, we're going to take a hit because the stop is not yet beyond break even. In other words, we're not able to lock in an open position profit. We'll end up with a loss on that trade, and then we're going to go short. Well, if the market then continues for like 3-4 days, it's probably going to go fine. But if after 1 or 2 days it's changing direction again to the upside from short to long, it's again going to be a losing trade. So if the market is volatile but not trending enough, it's not good. If the market is volatile and it's trending, it's excellent. If the market is not volatile and it's trending, it can be good. If the market is not volatile and not trending, it's horrible. So we could have then a market, I remember, I think it was in May of, what was this? In May of, yeah, here it is, May 2021, down 3%, and the market was doing nothing. So that's a pretty big loss compared to the market doing nothing. So another bad one I remember was, September 2015, September 2019. These kind of quick shocks or quick changes in trend can be costly for the program. So if the market changes trend, but then very shortly afterwards, like 1, 2, or 3 days afterwards, changes trend again, we usually get a double whammy. So not good. So we need some consistency. The trend should last for a while, I should say 3, 4, 5 days, and then it's really nice.
So I guess that implies that that is the characteristic of trends in the market, that they tend to last since your system
they need
is successful.
to last a certain number of days. Yeah. Now I'm using here trending days or trading days, which is not completely correct. It's really the distance traveled. It's one of the things that is used in the program. It looks at how long is the length, or how big is the length of the swing. In other words, what's the distance in percentage terms between the last significant low in the market and a significant high in the market. If that is like 150 points, we are pretty sure the trade is going to end up with a decent gain. If the market takes 10 days to advance only 20 points, then it's highly unlikely we're going to end up with a profit. So it's more the distance that we travel from A to B over a certain period that is critical in determining the profitability of the trade.
But that is a permanent, seemingly permanent inefficiency of the market.
Yeah, absolutely, absolutely.
Amit has a question there. He says, have you tried testing your program's correlation to the VIX?
Absolutely, absolutely. So it's a negative correlation to the VIX.
A negative correlation. So in other words, as the market starts, you go ahead.
Yeah, so it's counterintuitive. So you think, well, the volatility is high, it should perform fine. Well, if it's already high, and let me give an example, in 2020, so the volatility can be high, but then actually the market is remaining at the same level of volatility, or worse even, it drops down from like an 85% volatility as we saw in March 2020 to 30% volatility. It's usually not very good. It's so much really better if the volatility is increasing.
You'd really need to test the correlation to the positive acceleration of the VIX or something like that.
Yeah, absolutely. Yeah, very true.
Amit, do you have any other?
Yeah, I was wondering if it would make sense, just if there's like a certain level of the VIX that your program really outperforms, whether that's 20 or 18 or some number that obviously you could test. And if it's below that number, to just be long the SPX. And if it goes above that number, then you just then you turn the program on and just kind of have the program off if it's below a certain volatility.
Very good point. Absolutely. That works really nicely. So it's not a static number, of course, but you need to look at, say, it's as a fraction of what it has been lately. In other words, if it's, say, dropping to less than 75% of the mean of the preceding 3 months, then you better go to the side and go long SPX or something. While if it's exceeding, for example, 150% of what we saw in terms of volatility percentage for the previous 3 months, to take that example, then it's really going to go well. But that's only the first step. Then, of course, it depends on what is the market going to do. Is it going to remain in this low volatility environment? Okay, then it's probably not going to be very interesting for us to trade Enigma aggressively. On the other hand, if the market continues to go up from there, say volatility is 12% and it goes to 18%, that's like a 50% increase in volatility, then it could be really worthwhile. Or take the extreme case in 2017, when the market was like below 10% real volatility, and it goes from 10 to 15. 15 is still a low number, below the long-term mean volatility. It still starts to pick up. And so at the end of 2017, beginning of 2018, it's showing better numbers, although volatility was still low. Remember early 2018, before the volatility event in February, well, volatility was really low, and still it was performing nicely, 285, 217, and of course in February, even 3%. But then, like in March, its volatility was high, but it's coming down a bit, and it was having some problems. Nothing dramatic, but still, it's not easy to find a good rule that says, well, if it's below this level, I do this. If it's beyond that level, I'll do that. It's again, to use the same term, it's not stationary. It's probably doable to find something which is approximating what is a good level on a percentage basis, but I'm sure it's going to evolve over time.
But
it's a very good point.
Yeah, it's very interesting. And it's funny because for option strategies, people sometimes say don't enter when the market is, when there's a lot of volatility in the market, but that's sort of ignoring the point. If you're selling options that it may be about to decline, which would be excellent. And do you yourself trade broken wing butterflies?
Not really. So I'm more like a long gamma trader, long vega trader. So I'm not so much into shortfall. So probably on my book, it's approximately 70% long volatility and 30% short volatility. And of course, I use different time frames. Trading options short-term, very short-term, even intraday, 0 DTE, which is now a bit of a hype. I've been doing it for quite a while. And then on the other hand, longer term, like 5 to 10 months out. So
that's fascinating.
Different...
Yeah, that's great. So you're actually doing something completely different in your options trading than most people here probably are doing.
Very different, I'm sure. When I speak to Tom, I'm surprised that you do some very, very different things. But I mean, that's a good thing. If you all trade the same, it's going to become boring. Eh?
Do you see any argument at all for trading, for selling volatility in options positions?
Sure. Yeah. But of course, if you look at the net position of your book and your shortfall, but you have some far out of the money puts as protection, or you have some mechanism to start hedging if such and such a thing happens, then it's definitely okay. But that's not an easy thing to do. I mean, it's extremely difficult to time the market, or I should say, predict when something weird or nasty is going to happen. And as I'm not good at prediction, what I'll try to do is using some systematic hedging. In other words, for my portfolio, my option portfolio, I would always spend a significant amount of the profits that I make on the normal trading just for protection, which is, of course, probably my conservative bias, but I'm paying away a lot of insurance by systematic out of the money put buying as a permanent hedge, so to speak. And then I have a couple of algos that tell me when to add to these put buys.
That's
program.
fascinating.
So that's more tactical.
Do you have to finance those, or do you just inherently pay for it?
No, I need to, I mean, there are two things for the permanent put buying program, as I call it. So it's systematically all the time there is some hedging, not for the whole portfolio, but for a decent fraction of it. So I'm buying puts all the time. And so I finance it using portion of the profits that I make using the normal trading.
Sure.
So I'm not doing the trading to pay for the options. It's more like, well, if I have positions on, I need to be hedged to a certain extent. Then the tactical protection, as I call it, is really only kicking in when something seems to be happening in the market. Like, for example, I started buying some puts on Friday. Now, of course, this could be a waste of money, and it usually is, but it feels safer because my net delta is less positive when I have these out of the monies, which are still tiny, but if the market comes down, say 100 points, they're going to start to wake up. And because they are short-term in nature, these are like 7 days to maximum 3 weeks in expiration, in duration.
For the options?
So for the technical hedging, I use short-term options. And for the systematic put buying, I use the longer-term options, more like 3 months.
And we should talk a little bit more about, before we forget it, we should talk about the program, of course. So you have programs that you're offering on a variety of different platforms, but from what I gather, the options alerts, or I'm sorry, the signals through Enigma is actually one of the cheaper ones for people to buy.
Yeah, that's the best one. I mean, and the easiest to access. So when Tom is in Belgium, and he used to be in Belgium on a regular basis, then we were talking about this, and I said, well, maybe we could come up with something like a trade alert service to do this, and then it's up to the subscriber to implement it and to decide in what size. So it's the most flexible one. So also, as I'm based in Europe, for you as investors to invest in a European fund, it's tricky. It's not that easy. So I think the best solution is definitely using Enigma and then taking a subscription to the signals, which are transmitted via Slack or simple text messages. Slack is instant. It's like within 1 second. I think it's 0.20 of 1 second, so it's really fast, and it's not that time sensitive. So of course there are markets, buy at the market. Today there were a couple of orders, buy at the market. There was one sell on a stop at 41.09 when the market was at 41.12, so that was nearby. But usually with the simple text message, it's good enough. And I always wait like 2 minutes after I send out my signal to implement it myself, so that every subscriber has the possibility to at least get the trade executed before I implement it. Sometimes my later done trade is better, but most of the time, of course, my execution is slightly worse. Why? Because the market is in a certain move, say to the downside. When it hits that stop, it usually continues for a bit, and then I sell at a slightly worse price, or I'll buy at a slightly higher price, but it's insignificant. It's something like a point maybe, or half a point. But so I think the Enigma subscription is the easiest one. You're right.
And that's quite something, because it's probably a relatively minor in your overall portfolio of offerings across all the different platforms. So it's a way for Enigma subscribers to actually have an advantage in that respect.
Yeah. And I think I've added something in terms of the pricing. Yeah, here it is. So that's what Tom has come up with.
Okay.
So we actually have these 3 variants. So the more popular one is what I call the intraday long and short, which is basically everything. you have every single signal, so every single trade alert. So as of this year, 78 alerts and 36 transactions. And that are the prices for quarterly, 6 month, and annual. And people who say, well, I'm only interested in the long version. I don't need the short signals. They can do that. And then, of course, the one which I personally like as well, quite a bit, is the end of day, which is extremely simple and easy to implement, because you only have one trade a day maximum. And sometimes you only have like 1 or 2 trades a week, and that's it. And that can be, and it can be combined, of course. Tom has set up these bundles. So, but that's basically what.
And if people are interested in that, they can go to erimir.com. Is it /Enigma or?
Just go to Erimir. Let's see. So if I show it here.
Oh, I've got it here.
So,
yeah, it's info. I'm sorry, it's info.erimir.com /Enigma.
Exactly. So here you see, for example, the trade alerts, the messages. See if it's popping up. So these are all the trade alerts. So this year, for example, or the last 50. I can take the last 100, of course. If I say so this is what we have so far. And like today, you see there are quite a bit of messages. 10 messages, but only 3 trades, I think. So we are there, sell 1 at market, and then of course the confirmation. I sold it at 4,019, then sell 1 at market with position now at, so it's always very simple. Bring over. So can you see this Slack?
Yeah. Looks familiar.
Okay. Fine. So for example, if I just scroll up, whatever day, it doesn't really matter. See here on, so you have buy 1 at the market, net position is 0. Then when it's filled, which is of course a couple of seconds later, or 2 minutes later, you see 755, 757. Then you buy at that price. Then here, sell 2 at the market, sold them at that price. The Monday current position was -1. We buy 1, we are flat at the end of the day, and so on. So a couple of trade alerts during the day. This is a busy day, January 25th. See many signals. We end up with -3. Then we cover it here next day. Then on the Monday, January, it's a week ago. So we sold 2. So the position goes, and here was another one without being filled. Here we got filled on this first one, on the stop at 40.30. And then we actually reverse completely from -2 to +1. So we buy 3 contracts at the market at the end of the day. See, we go from -2 to +1. So it's really simple. Market orders, stop orders, and sometimes a limit order. If it's a limit order, we usually use limit OCO stop so that we don't miss out on a trade. Because at the very beginning, it's in a way funny, but actually I don't think it is. We started the program with Erimir on May 16 or 17, and we instantly went into a drawdown. So
that's the way it always is.
It took some time to recover, and then we went up, and then we had another big drawdown, and now we're back up again. You see, it's starting with 20. It is now at nearly 30. So it's doing okay. But so we have drawdowns. I mean, it can't be avoided.
Absolutely. Anybody else have any questions? We're gonna for sure let them go at the hour. So I got a couple of questions.
Okay.
Good.
Good.
You can, Luke can stay maybe just not much longer. So, anybody got any, I guess, that's very interesting. Anybody have any other questions?
I'll give another question. I apologize if I'm taking too much time here.
No problem.
First of all, your returns seem really good. What it seems like you're selling also is a Signal subscription. Am I correct in assuming that?
Yeah, this is Signal subscription. Absolutely.
So in your presentation, you made it seem like a big portion of your offering is the risk management side, the sizing. How does that translate in a Signal? Would that be like specified for the specific trader what size he should buy, or is that just a buy now and sell now type of subscription?
Very good question. So that boils down to the convexity issue. In other words, how to build bigger positions when it's going your way, and how to scale down or reduce the size when it's going against you. So how it's translated with the signals is it says, well, buy one, buy one, buy one. Like as I showed earlier, you start with short one, short the second one, and then suddenly buy three to reverse the position. Or it could be building the position up from 1 to 4, and then at the end of the day, scaling it back down to 2 or 3. So that's one element. But then at the same time, you could say, well, if I take this simple chart, this one, and you say, well, if I have an account of, in this example, of 40,000, and I'm willing to take some 15% drawdown, I should use this kind of signal. In other words, half a delta, in other words, 50 deltas per signal. If I want to trade it more aggressively, of course, my drawdown is going to go up, my return is going to go up, my standard deviation is going to go up. So it's a linear relation, and you can basically scale it up or scale it down as you wish. In other words, the trade alert service simply says buy one, buy two. But if you say, well, that is only translating it to a 15% drawdown, and I want to trade it with a 30% drawdown, potentially, you can simply double up the trade size. If you say, well, I only want to do this with a very tiny drawdown of maybe 10%, you take 2/3 of the delta. So with the micro EMinis, instead of using one EMini, you could use, say, for example, what shall I say, 5 or 7 or 8 micros. So you can scale it down as a function of your risk profile, as a function of your tolerance for risk, tolerance for drawdown. So it really depends what you feel comfortable with. But say the standard is for building it with a 15% drawdown, as on this slide is shown. And so that's like the standard version. If you say, well, this drawdown of 15% is too big for me, you can simply scale it down by reducing the delta. And instead of trading one S&P contract, you could trade 8 micros, or half an S&P contract, in other words, 5 micros. And if you feel more comfortable, adding 1 micro or whatever. So that's the way that people implement it. And of course,
Understood.
It depends on the account size. Yeah. So that's the simple way to do it.
Understood. Thank you.
Super. One person has a question in the meeting chat. How can I get the recording? Just check our site. It'll be on there in a couple of days. Any other final points? Thank you very much for talking to us at such length. We really appreciate it. I know it's getting late there.
It's exactly midnight here.
Oh my goodness. We'll let you go.
Not to worry, not to worry.
Thank you very much.
Okay, okay. Well, if there are no more questions, well, thank you for the good questions. And it was a pleasure talking to you all.
Thank you. And I guess we'll end the meeting there. Thank you. Good night.
Okay, good night. Bye-bye now.
Bye.